Welcome to the deep dive. Today, we're really digging into a pretty complex global picture. It's summed up perfectly by this theme in your sources: the glitter and the grind.
That's a great way to put it.
Yeah, and it's not just, a catchy phrase. It really feels like the global reality right now. You've got these key assets, think metals like gold, they're shining brightly. That's the glitter, that defensive strength. But at the same time, you look at the hard economic data, credit numbers, exports, these massive policy shifts, and it all points towards a slowdown, a real structural grind.
Absolutely right. And our job today really is to take this, well, incredible stack of sources you've pulled together.
There's a lot in there.
There really is. Everything from the nitty-gritty of India's huge new spending plans, their capex, to this really radical contrarian investment idea that's betting against the popular high-value markets.
Right.
We need to connect those dots that might seem totally separate at first glance. We want to pull out the essential insights so that you, listening, can see the whole structure.
Yeah, filter out the noise, basically, whether it's coming from the super optimistic bulls or the, more cautious bears.
Exactly. Cut through it all.
Okay, so the big picture we're trying to connect here, it feels like there are three huge forces kind of colliding right now.
I think that's right.
First, you've got this, undeniable return of protectionism, and it's aggressive. Plus, all the geopolitical turmoil swirling around, that's the global headwind, the foundation of the grind.
It's definitely force number one.
Second, there's India's own economy, which is, it's complicated. It's a paradox, really. You see these bright spots, the glitter, like consumption holding up, getting a boost from policy. But then you see the grind, too serious slowing in credit, export numbers taking a hit.
A real split picture there.
And third, there's this fundamental shift happening in how big money institutional investors are thinking. They seem to be moving away from what they see as, let's say, frothy valuations.
Overheated, yeah.
Towards safety, towards diversification, and crucially, towards finding value globally, maybe in places people aren't looking.
And it's really those policy shifts, the things happening in the first two areas, the global protectionism, India's internal response, that are driving those big investment decisions in the third part.
Makes sense.
So to really understand it, we have to start with the global picture.
Yeah.
That external pressure, it really dictates so much of the internal strategy, how countries like India are forced to react.
Okay, let's unpack this. This dramatic shift in global policy. It's definitely leaning hard into protectionism, putting up barriers. It really feels like it's setting the stage for a long, maybe painful global grind.
As it does.
And what's striking, really striking in your sources, is how they immediately draw this very strong and frankly kind of terrifying parallel to one of the darkest moments in modern economic history.
It is fascinating, isn't it? And maybe a bit disheartening how quickly we seem to forget history's lessons sometimes. The comparison being made, and it's framed as a serious warning, is to the Smoot-Hawley Tariff Act. Back in 1930.
Right. Nearly a century ago.
Exactly. That act, it raised tariffs on, over 20,000 imported goods. The idea then, just like some of the rhetoric today, was supposedly about protecting American jobs, American industries from foreign competition.
And what actually happened was, it was an economic disaster. That one move, that unilateral action, it kicked off immediate devastating retaliation from dozens of other countries.
Over 25 countries, yeah.
It didn't protect the U.S. economy at all. It starved it.
Precisely. That cycle of retaliation just poured gasoline on the Great Depression.
Right, yeah.
Made it dramatically worse. The numbers from back then are just staggering.
Yeah.
Those tit-for-tat tariffs led to a 60% collapse in U.S. exports.
Yeah.
60%. And global trade volume overall dropped by 2/3, 66%.
Wow.
GDP itself shrank by almost 30% between 1929 and 1933. The sources are really emphasizing this history lesson, this warning, because tariffs are making a serious structural comeback right now.
And they're coming back with incredible specificity. It's not just broad strokes. We're seeing proposals for really deep, steep new tariffs, especially targeting sectors where the U.S. feels maybe strategically vulnerable.
Like what specifically?
Well, for example, a 100% tariff on imported, branded, or patented pharma drugs, scheduled for October 1st.
100%. That's basically shutting the door.
Completely. Then there's talk of 25% on heavy trucks, 30% on upholstered furniture, 10% on softwood timber and lumber. It's specific.
That is a huge hike.
Uh,
And this is where it stops being just about raising revenue, right? It becomes strategic, almost coercive industrial policy.
How so?
Because the sources highlight this critical, very deliberate loophole in these proposals.
Ah, right, the exemption.
Exactly. These massive tariffs, they're completely waived, exempted, if the foreign company is already building a plant or has one under construction in the USA.
So it's protectionism, but with this built-in lever to force companies to build onshore. It's a direct financial threat. Invest here, build here, or we basically price you out of our market.
Exactly. It's a build it here or pay triple kind of approach. And you can already see the effects even before all these proposals are fully law.
How?
U.S. customs duty and excise collections. The monthly numbers have shot up dramatically.
Really?
Yeah, we're talking about a jump from around $6.5 billion collected back in January 24 to $29.5 billion in August 25.
Wait, 6.5 to nearly 30 billion in what, less than 2 years?
That's right. That massive spike is a direct measure of the increased cost burden hitting imports. Costs that, ultimately get passed on to U.S. consumers or U.S. businesses importing parts.
That's almost a 5-fold increase.
Right.
Incredible. And it's not just hitting imports from, say, China, is it?
Not at all. That's a key point in the data.
Right.
Goods from major partners like India and Brazil are still facing steep tariffs, 50% on U.S. imports in some cases.
50%.
Yeah. So while the political talk might focus on one country, the actual economic drag is much wider. It hits global supply chains, trade dynamics, everywhere.
Okay, so if those tariffs are the new tax on physical goods moving across borders, then this new H-1B policy, it sounds like the equivalent tax on intellectual talent. The $100 K visa shock, as the sources dramatically put it.
It really is a shock. The headline change is this new fee, $100,000, slapped onto fresh H-1B petitions.
$100,000.
Per petition. It starts September 21st, 2025, effective for 1 year initially. And the absolutely critical thing for you listening to grasp is who pays.
It's the employer, right?
The employers must cover this fee. It's mandated. This is just a massive, immediate add-on cost. You already got the existing application fees, maybe $2,000 to $5,000. Now add another $100,000 on top. For many companies, especially startups or maybe medium-sized firms, it makes hiring new foreign STEM talent, well, almost prohibitively expensive.
Which just raises this fundamental question about the U.S. tech sector, doesn't it? I mean, it's built, it's fueled by global talent.
Absolutely.
You have that widely reported quote from NVIDIA's CEO, Jensen Huang. He said something like, "The miracle of NVIDIA, it wouldn't be possible without immigration."
Right.
This policy seems to fly directly in the face of that reality, of what America's most successful, most innovative, strategically vital companies say they need. It feels like shooting yourself in the foot, talent-wise.
That contradiction is definitely fueling this intense global competition for that very talent. And this tightening, it's not just a U.S. thing. That's another key takeaway.
Ah, right. It's broader.
Globally, there's this clear synchronized trend. Stricter, more expensive immigration policies are popping up everywhere. Look at the UK minimum salary threshold for work permits jumped 7.7%, up to over £41,000.
Wow.
Sweden, they more than doubled their minimum salary threshold for work permits just last October. Australia, trying to manage population growth, cut student visa issuance by a huge 34% last fiscal year.
34%.
And Canada's planning significant cuts too, maybe 10 to 16% fewer approvals for students and workers in 2025.
So the traditional magnets for top global talent, the US, UK, Canada, Australia, they're all collectively kind of building walls, raising the price of entry.
That seems to be the trend.
Yeah.
But your sources also flagged a really fascinating counterpoint.
Oh, yeah.
One major economic power is doing the exact opposite, actively lowering the barriers for highly skilled workers.
Who's that?
China. They launched a new visa category, the K visa, starting October 1st, 2025.
K visa.
Yeah. It's designed specifically to attract international STEM professionals. And crucially, it gets rid of the usual big hurdle. You don't need an employer to sponsor you.
Ah, that's huge.
Yes. So while the West is making it harder, more expensive, more complicated to bring in talent, China's actively trying to suck that talent in. They're trying to leverage the new high costs and hurdles elsewhere. It's a classic strategic move in this kind of geopolitical competition.
Right. Use your rivals' policies against them. And all this tariff tension, the talent migration battles, it's all happening against this backdrop of just serious, widespread political instability. Markets hate uncertainty, right?
They absolutely do.
And the sources just list off this whole series of recent political shocks in major economies. Japan's prime minister resigned, UK deputy PM resigned, France's prime minister lost a confidence vote.
The PM of Nepal resigned amid protests, too.
Right. And then you've got significant ongoing protests, leadership changes happening in places like Indonesia and Thailand.
It's a lot of instability globally.
So if you connect all those threads, the message seems pretty clear, doesn't it? The global operating environment is just riskier. It's more fragmented. It's subject to way more political shocks than maybe we've been used to for decades.
I think that's undeniable. And that fragmentation, that increased risk, that's precisely what creates those global economic headwinds, the grind we talked about. It influences every investment decision, every national policy strategy now. It forces countries to look inward to find growth at home.
Okay, so this is where the story takes a really interesting turn. Because despite all those global jitters we just talked about, despite it getting harder to export, India seems to be showing these signs of, well, vibrant internal glitter, especially in consumption. But the underlying macro data, the big picture numbers, they're still showing that grind. It's an incredibly confusing kind of split picture if you're trying to figure out what's really going on.
It really is a paradox. And that glitter, the consumption strength, it's being deliberately fueled, you could say, strategically stoked by government policy targeting ordinary people and key sectors.
Like the GST changes.
Exactly. The GST 2.0 expansion, this isn't just broad tax cuts, it's quite targeted. We saw GST cut to 5% on agricultural equipment, complete exemptions introduced in the dairy sector.
Things that directly impact the rural economy.
Precisely. The Union Agriculture Minister was explicit, saying these changes would be a boon for the farmers and help the common man, focusing right on those essential rural economic drivers.
And you can see the effect almost immediately in industry expectations, right? Small car sales, which had been pretty sluggish.
Stagnant, even declining in some periods.
Right. Now they're projected to grow by a solid 10%. The whole passenger car market projected up 6 to 8%. That's significant.
It is. And you had the co-founder of a major industry group saying point blank that these GST cuts will surely trigger growth in the sales of LED TVs and ACs and push the Make in India agenda. It connects directly to consumer durables.
And it's not just projections. It translates into real price cuts for consumers, especially at the higher end.
Yeah, the Mercedes-Benz India CEO confirmed they passed the entire GST reduction straight through to customers. That meant a price benefit of somewhere between 5 and 8%.
That's a tangible stimulus. If you were thinking about whooping, that might just push you over the edge.
That's exactly the idea. Encourage consumption now.
And we have actual data points backing this up, confirming the positive momentum.
We do. Domestic passenger vehicle wholesales, that's cars shipped from factories to dealers, were up 5.4% year over year in September.
Okay.
And, maybe more tellingly, e-commerce gross merchandise value, GMV, which is basically a proxy for online retail spending.
Especially during the big festive sales period.
Exactly. That increased by 22% in just the first 6 days of those crucial festive sales. So yeah, retail consumption is definitely providing that glitter.
Okay, but here's the paradox, the critical catch. The grind hidden in the macro data. This needs a closer look.
It really does, because if you look under the hood of the GDP numbers, the national accounts, they tell a slightly more worrying structural story. Nominal GDP growth, that actually decreased quite a bit, down to 8.8% in Q1 of fiscal 25.
Down from what?
Down sharply from 10.8% in the previous quarter.
Okay, 10.8 down to 8.8 nominal growth. But hang on, didn't real GDP, the inflation-adjusted number, actually accelerate? That sounds contradictory.
It sounds contradictory, but it's technically true. And this is a really crucial distinction worth spending a moment on for you, the listener.
Okay. Why did real GDP go up if nominal GDP went down?
The only reason real GDP accelerated, despite that slowing nominal growth, was because the GDP deflator decreased significantly, fell sharply.
And the GDP deflator is...
It's a measure of the broad price changes across the entire economy. Everything, not just consumer prices. So a sharp decrease in the deflator means that prices across the economy were rising much, much slower than before. Maybe even falling in some areas.
Ah, okay. So lower inflation or even some deflation.
Exactly. That mechanically boosts the inflation-adjusted growth rate. It makes the economy look faster on paper, but it masks the underlying reality. The actual rupee value growth, the revenue generation across the economy, was slowing down quite significantly.
So it points to maybe weaker demand, or businesses just not having the power to raise prices.
Could be either, or a mix of both. But yeah, it suggests the underlying economic engine isn't generating the same top-line growth it was, even if the purchasing power held up a bit better because inflation cooled.
Okay, that makes sense. And you'd expect to see that kind of deceleration reflected in the credit markets, right? Which are like the fuel lines for the economy.
You absolutely would, and you do. Retail credit growth, year over year, slowed down to 11.8% in August. That's down from 13.9% a year ago.
So consumers borrowing less, maybe?
Yeah.
Or banks getting tighter?
Could be. And it's not just consumers. Industrial credit growth year over year also slowed significantly, down to 6.5% from 9.7% a year ago.
Wow, that's a big drop on the industrial side.
It is. When you see both consumer and industrial credit slowing like that, it's a pretty clear signal that the overall economic velocity is decreasing. Both consumption and maybe capital investment are feeling the pinch.
And let's not forget those global headwinds we started with. How do they feed back into India's picture?
Well, directly into the export numbers. Performance there is flagging quite dramatically, especially exports going to the crucial U.S. market.
How bad is it?
Year-over-year growth in exports to the U.S., it dropped sharply to just 7.2% in August.
Only 7.2% growth.
Yeah, which sounds okay in isolation, but compare that to the average growth they were seeing from January through July. That was a really robust 25.6% average growth.
25.6 down to 7.2. That's a cliff edge.
It's a dramatic fall. And it connects right back to what we discussed, those rising U.S. tariffs, the higher customs duty collections. It's hitting India's export numbers directly. That's the grind biting.
Okay, and what about market sentiment? Any signals there?
A slight cooling, maybe. The number of new demat accounts being opened, that's stock trading accounts, slowed a bit to 2.6 million in August. Suggests maybe a little less retail frenzy compared to peaks.
Okay.
And perhaps more significantly, foreign institutional investors, the FIIs, they were net sellers in September. Offloaded quite a chunk, about $341.7 billion worth of Indian equities.
Okay, FII selling off. That usually spooks the market, doesn't it? But hang on, there's another side to this in your data.
There is indeed.
Domestic institutional investors, the DIIs, think mutual funds, insurance companies, pension funds here. They were massive net buyers, bought $630.5 billion in September.
More than soaked up all the FII selling.
Yeah, absorbed it all and then some. So is that a sign of real, durable, structural strength in the Indian market? Or is it more like, large, perhaps policy-aligned domestic funds stepping in to stabilize things temporarily?
That's the multi-billion rupee question, isn't it? And it's probably a bit of both.
Yeah.
Look, the DII strength is definitely a major structural change compared to past cycles. Back then, if FIIs pulled out like this, you'd almost certainly see a significant market drop.
Right.
This time, that domestic flow, a lot of it driven by systematic investment plans into mutual funds, mandatory pension contributions, it's acting as this powerful, almost semi-permanent shock absorber.
Providing a floor under the market.
Exactly. Whether you call it pure structural strength or maybe policy influence stability, it certainly differentiates India from many other emerging markets that are still incredibly vulnerable to foreign outflows. It shows the local investment ecosystem is maturing fast, even when the foreign investors get nervous.
Okay, so moving into the third piece here. This section seems to explain the response, the steady hands, as your sources put it. The strategic, long-term policy moves being made to counter both that internal credit slowdown we just discussed and those external protectionist pressures.
That's right. India appears to be clearly doubling down on self-reliance, on boosting domestic industrial capacity, trying to build resilience to weather this global storm.
And the first tool they're using seems to be pretty direct trade policy, protecting local industry.
Absolutely. The first line of defense against cheap foreign competition is often robust trade policy tools. And India is using anti-dumping duties quite heavily right now. And it's very specific, very targeted.
What kind of examples are we seeing?
Well, the sources list several key ones. They've proposed duties on elevators imported from China, ranging from 24% up to nearly 52%.
Oh, that's steep.
Similar duties on crane imports, 25 to 52% slapped on the CIF value, the cost including insurance and freight. Even crucial industrial inputs, like certain types of electrical steel from China, are facing duties somewhere between $220 and $415 per ton.
Okay, so that's effectively making it much more expensive, maybe prohibitively expensive, to import these specific things, heavy machinery, core industrial materials.
Mm.
It feels like a shift away from just collecting revenue on imports towards actively trying to build domestic capacity in those sectors.
I think that's exactly the signal. And it's not just duties. They're also using outright import restrictions in some areas,
Like what?
restricting imports of silver and also certain types of unstudded jewelry coming in from several Asian countries. That restriction runs until March 2026.
Silver and jewelry. Why
Yeah.
those?
Well, it's not just about the final product. It's about protecting and nurturing the entire domestic value chain. From processing raw materials like silver all the way through to finished goods manufacturing. It's classic import substitution strategy, really. Shielding local players while they hopefully scale up.
Okay, so trade defenses are up. But the really big story here, the one that shapes the long-term outlook, seems to be the sheer scale of the capital expenditure, the CapEx commitments.
Oh, absolutely.
It looks like the government and the big private sector players are really aligning on policy goals here, committing massive sums of money to build physical assets, factories, power plants, infrastructure. This is where those steady hands are putting their money where their mouth is.
The numbers are genuinely staggering, and they really speak to this strategic push towards self-sufficiency, particularly in critical areas. Let's break it down.
Okay.
In energy and power, which
Yeah.
is fundamental. You've got NTPC and MPCIL jointly investing $420 billion in a big 2,800 megawatt nuclear project out in Rajasthan.
$420 billion. That seems incredibly high. Are you sure about that figure? Let me double check the source outline. I see the outline says $420 BN for NTPC, NPCIL, and LCO $300 BN, Adani $105 BN, etc. These look like rupees, not dollars. Let's assume these are billions of rupees for now, which still represents very large sums. So 420 billion rupees for the nuclear project.
Ah, good catch. Yes, rupees makes much more sense in context for domestic projects of this nature. Apologies. So 420 billion rupees for nuclear, then an LSCO investing 300 billion rupees in a new smelter and a coal power plant. Adani Power putting 105 billion rupees into an 800 megawatt thermal plant. The message is clear. Prioritize energy security, prioritize domestic processing of raw materials.
Okay, rupees, not dollars. Got it. And what about the electronics and semiconductor push? That seems like a huge strategic priority given all the global supply chain anxiety.
Huge priority. The government approved 5 projects worth a combined $18.3 billion this time. The outline specifies USD here in just the first batch of the Indian semiconductor mission.
Okay, 18.3 billion US dollars. Significant.
Very. The biggest single commitment is the Tata Electronics partnership with PSMC. That's an $11.0 billion project. Micron's project is $2.8 billion. And separately, PG Electroclast is setting up a 10 billion rupee electronics plant, back to rupees there.
Right. So multi-billion-dollar bets in semiconductors, multi-billion rupee bets elsewhere. These aren't just pilot projects. These are foundational investments trying to build entire ecosystems.
Exactly. And on the broader infrastructure side, look at shipbuilding. The cabinet approved a massive package, 697.3 billion rupees for the sector. And crucially, they granted large ships infrastructure status.
Why is that infrastructure status so important?
It sounds like a small bureaucratic change, but it's huge financially. It unlocks access to long-term financing options, tax breaks, and various development incentives that are usually reserved for things like roads and ports.
Yeah.
It makes these massive, long payback shipbuilding projects much more financially viable.
Okay, these figures are genuinely impressive. They signal real long-term commitment. But I have to bring back a dose of the grind here. We know big ambitions often run into execution problems,
Comes
right?
at a risk.
The sources mention that cost overruns on existing government projects already add up to something like 3 trillion rupees.
That's a huge number.
So when you're talking about launching even bigger projects now, on this scale, aren't you inevitably going to run into historic labor shortages, supply chain bottlenecks, bureaucratic delays, things that could just hamstring these projects and drag out the timelines massively?
That is absolutely the essential grind aspect of this massive ambition. And it's a necessary reality check. That 3 trillion rupee figure for existing overruns, it highlights the execution challenge perfectly.
Yeah.
The financial commitment, the policy intent, it's there. But turning that into steel and concrete, into functioning factories, that requires overcoming serious domestic hurdles. Things like land acquisition, which is always complex, legal challenges, coordinating between dozens of different government agencies. And yes, absolutely, acute labor shortages, especially for the skilled roles needed in high-tech areas like semiconductor fabrication.
So the money might be committed instantly, but the actual benefits, they're going to be delayed. And probably costs more than planned.
Highly likely. That operational friction is real. The policy needs patience. The system needs to be able to absorb these delays and cost increases without losing faith in the long-term goal.
Okay, shifting slightly to the regulatory and fiscal side, the stability part of the steady hands. The Reserve Bank of India, the RBI, through its Monetary Policy Committee, the MPC, they kept rates steady, right?
Yet maintained a neutral stance, kept the key repo rate at 5.5%. That signals stability, continuity, no sudden shocks.
But they did more than just hold rates, didn't they? They adjusted their forecasts.
They did. And importantly, they signaled confidence. They actually revised their GDP forecast upwards for the current fiscal year, FY25, bumped it from 6.5% up to 6.8%.
So despite the global gloom and the domestic grind, they think growth will be stronger.
That's the signal. They seem confident that the domestic momentum, that big capex push we just discussed, will be enough to overcome the global headwinds. And at the same time, they revised their inflation projection for next fiscal year, FY26, downwards, from 3.1% down to 2.6%.
Okay, so faster growth, lower inflation. That's the ideal scenario they're painting. A textbook signal of confidence.
Very much.
And supporting that narrative of stability, you have the GST collection numbers. They seem consistently strong, which is often seen as a sign the formal economy is doing well.
Right. Gross GST collection rose 9.1% year over year in September, hitting $1.89 trillion. Solid growth.
But you flag something deeper in the mobility data.
Yeah, look beyond just the tax collection. Toll collection from highways hits $70.5 billion in August. And e-way bill generation, that's the electronic permits needed to move goods across state lines, hit $129.1 million.
And those numbers are significant because
both of those figures, toll revenue and e-way bills, hit their second highest levels ever in August.
Second highest ever. Wow.
Yeah. E-way bills in particular track the organized movement of goods. The fact that both tolls and e-way data are near record highs, that signals incredibly robust physical movement of goods, strong commercial activity underpinning the whole consumption and industrial story. It suggests the formal economy is humming.
Okay, that's a strong counterpoint to the credit slowdown. Interesting. And finally, on the regulatory front, SEBI, the market regulator, making some moves.
Yeah, proactive step to deepen the capital markets.
Yeah.
They classified REITs, real estate investment trusts, as equity instruments.
Why does that matter?
It basically makes them more accessible, easier to understand, and potentially more attractive for a wider range of investors, including potentially larger institutions that have mandates restricting them to equity. It could boost participation in that asset class.
Yeah.
And I also approved some changes to the rules around minimum public offers and minimum public shareholding, linking them more closely to a company's market cap. The goal there is to encourage broader public ownership and better trading liquidity, especially in the larger listed companies, over time.
So all these steady hands moves, the trade defenses, the massive capex, the stable monetary policy, the regulatory tweaks, they're all laying the groundwork, trying to build resilience for the long term, hoping this immediate macro grind doesn't derail that bigger strategic vision.
That seems to be the plan. Build domestic strength to ride out the global storm.
All right, so we've painted this really complex picture, haven't we? You've got high valuations in a market like India, you've got significant policy turmoil happening globally, and this split domestic economy battling glitter versus grind.
Yeah, it's a lot to process.
Yeah. So the obvious question then, for you listening, is where does the smart money go in this environment? Where should capital flow? And your sources seem to offer two very strong and interestingly converging answers.
They do.
Gold and deep global value investing.
Exactly. Let's start with gold. The case for gold right now, it's not really speculative. It's profoundly defensive. It's positioned as the ultimate form of glitter, like a hedge against all this instability.
And it has a track record, right? Historically, it's done well when things get rough.
Consistently. It's acted as a ballast, often outperforming broad equity markets like the Nifty during periods of real economic stress or market turbulence.
Do we have specific examples? They help make the point.
Absolutely. Think back to the 2010-2011 period. There was a lot of market volatility then. The Nifty actually declined about 12%. Gold, it soared 63%.
63%.
Right.
While stocks fell. Okay.
More recently, remember the immediate shock of COVID, January to April 2020. The Nifty just plummeted, down 38%. Gold surged 14% in that same short period. Investors just scrambled for safety, for something tangible.
So it acts as that safe haven.
Precisely. And the rationale right now goes beyond just standard inflation hedging, though that's part of it. Investors are seeking safety amidst this profound global chaos we've discussed, the geopolitical tensions, and critically, maybe a fading trust in the stability of fiat money itself.
Fading trust in currencies.
You see it reflected in institutional behavior. Central banks around the world are actively increasing their gold reserves.
Why are they doing that?
The thinking is they're hedging against perceived fiat currency risks. Maybe risks linked to the US dollar being used as a policy weapon, or just general instability in the currency system. When the central banks themselves are buying gold as a hedge, it powerfully reinforces gold's role as a store of value in an uncertain world.
Okay, so for 2025, the conclusion from the sources is that gold isn't just another asset. It's positioned as this critical hedge against that whole cocktail of risks we've identified. Frothy stock valuations, geopolitical flare-ups, sticky inflation pockets, currency volatility.
It's almost the simplest way to express a lack of faith in the current system holding steady.
Makes sense. Okay, so that's gold. But the second investment thesis you flagged is maybe more radical, definitely contrarian.
Yeah, betting on deep global value. And this strategy is really championed in the sources by this one fund manager, Siddhartha Bhaiyya.
Right. Tell us that story, because it starts with a really bold contrarian call he made earlier.
It does. Bhaiyya became famously bearish on the Indian market back in 2024. He looked at the valuations and basically said, this is significantly overvalued compared to its long-term potential.
So what did he do?
He acted decisively. Initially moved his domestic portfolio into almost 90% cash, then shifted most of that cash into gold, and then started launching specialized global funds, basically saying the opportunity wasn't in the expensive domestic market anymore.
He felt India was pricing in too much good news.
Exactly. Too much optimism relative to the underlying risks and potential.
And did that contrarian view pay off?
Well, his first big global move certainly did. He launched a Far East-focused fund back in May 2024. Now remember, May 2024, pessimism about China, about its regulatory crackdowns, it was absolutely peaking.
Everyone was running scared from China then.
Almost everyone. He launched his fund right into that fear, and he timed it beautifully. The sources note that the Hang Seng Index in Hong Kong is up a scorching 48% over the past year since then.
48%. Wow. So he called the bottom when sentiment was terrible.
Made a hugely successful timing call precisely because he was willing to go against the overwhelming institutional herd fleeing due to geopolitical fears.
Okay, so he's proven he can be contrarian and right. Now he's applying that same lens to the rest of the developed world.
That's the idea behind his new global value fund. It's targeting about 30 stocks, specifically chosen because they're beaten down. And look at the allocation, heavily tilted towards regions that are widely seen as fundamentally cheap right now.
Where specifically?
40% US, 40% Europe, and 20% in developed Asia, specifically Singapore, South Korea, Hong Kong.
Okay, so heavy on US and Europe, where valuations are generally lower than India's right now.
Exactly. The core thesis is simple, but it's extremely powerful in today's market. You bank on established, global, major companies, businesses with real assets, real cash flows, dominant market shares, eventually reverting back to what he calls saner valuations.
And the valuation gap he's trying to exploit, it's pretty big.
It's immense right now. Let's put some numbers on it. If you look at price-to-earnings ratios, PE ratios, as of July 31st,
Yeah, okay.
the MSCI India Index was trading at a PE of around 25.
25 times earnings. Okay, pretty high.
Now compare that. MSCI Europe was at a PE of 16, and MSCI China down at 14.
16 and 14 versus 25. That is a massive difference.
It's huge.
Yeah.
That's the opportunity institutional investors like him are trying to capture. They're looking for value where maybe others have been too scared by headlines or too focused only on their domestic market to look.
So you can essentially buy shares in, say, a big global automaker or a major European bank at a fraction of the valuation multiple you'd pay for an Indian equivalent, even if they have similar or maybe even better global businesses.
That's the core idea of global value investing, especially right now.
There's always a risk with deep value investing, isn't there? The dreaded value trap.
It's a perennial danger, yes.
Companies that look cheap, but they're cheap for a reason, because their underlying business is fundamentally broken or it's in structural decline and they're just never going to recover. How does this specific strategy try to avoid falling into that trap?
That's where, according to the sources, this sophisticated second layer of filtration comes in. It's crucial. They absolutely acknowledge that these beaten down companies often look terrible based on their current metrics. Things like earnings per share, EPS, or return on capital employed, ROCE, might be really low or even negative.
Right, which scares most people off.
Exactly. So instead of just relying on those depressed current numbers, the team digs into the historical performance data. They look at industry cycles, and they try to estimate what the growth prospects, the EPS, the ROCE, might look like if the company stages a turnaround, if things revert to some kind of normal.
Okay, can you give an example of how that works?
Sure. Imagine a big European industrial company. Maybe because of the energy price shocks and supply chain chaos, its current ROCE is, say, only 2%. Looks awful.
Yeah, terrible return.
A typical value screen might just throw it out.
Yeah.
But if this fund's historical analysis shows that same company consistently achieves, say, 18% ROCE during normal economic cycles before the recent shocks, then they're making a bet on that reversion to normalcy. They're betting that the underlying business quality, the latent potential that delivered 18% ROCE before, is still there. It's just temporarily depressed.
So they're ignoring the temporary cheapness based on current bad numbers and focusing on the proven potential for recovery. That's how they try to avoid the value traps, the companies that are cheap, because they're just bad.
Exactly. They're betting on recovery, not just cheapness.
Okay, that makes sense. Finally, we should probably touch on the operational side of this new global fund, because it says something about who it's for, right?
It definitely does. It reflects the scale of capital they're trying to attract. The minimum investment is very high, $1 million US.
$1 million minimum. That's way above the standard limit for individuals sending money abroad from India, the LRS scheme.
Way above. The liberalized remittance scheme, LRS limit, is typically $250,000 per person per year.
So how do they get investments of $1 million or more?
Because of that high minimum, they're relying heavily on a different route called OPI, Overseas Portfolio Investment.
OPI?
Yeah. This route allows domestic Indian companies, or LLPs, limited liability partnerships, to invest overseas. And crucially, they can invest up to 50% of their net worth with basically no upper monetary cap.
So this fund isn't really aimed at individual retail investors using LRS. It's designed for Indian companies, maybe family offices structured as LLPs, to invest their corporate balance sheet money globally.
Exactly. It's an institutional play, or for very high net worth entities structured appropriately.
And the fund structure itself, the lock-ins and taxes, that also sends a strong signal, doesn't it?
It really does. It's specifically designed to attract only very patient long-term capital. There's a 1-year hard lock-in period, and then even in the second year, there's a steep exit load, a penalty for leaving early.
Okay.
But the real kicker is the tax treatment on redemption. If investors pull their money out within the first 2 years, the fund has to pay out the proceeds net of tax, calculated at a very harsh rate, potentially 42%.
42% tax. Ouch.
Very ouch. But if you wait, if you stay invested beyond 2 years, that tax rate on realized gains drops dramatically, down to just 12.5%.
12.5% after 2 years versus 42 before. That's a massive incentive to stay put.
It's a huge incentive. The structure basically mandates investment beyond 2 years. It perfectly aligns the investor's incentives with the long-term, deep value turnaround nature of the investment strategy itself. They're literally taxing short-term thinking, short-term impatience right out of the equation.
Wow. Okay, that's a fascinating strategy, structure and all. Hashtag outro. Well, we have certainly taken a deep dive today into this whole glitter in the grind dynamic.
We definitely covered a lot of ground.
Yeah, we've seen how the world seems to be rebalancing through these, well, pretty aggressive power plays, using protectionist tools like that staggering $100,000 H-1B fee, sweeping new tariffs that echo Smoot-Hawley.
All set against that pervasive backdrop of political turbulence and uncertainty we discussed.
Meanwhile, domestically, India is grappling with its own paradox. That cooling credit growth, the structural warning sign in the slowing nominal GDP.
The grind.
Right. Yet at the same time, you see this real consumer enthusiasm boosted by those targeted GST cuts. And this incredible, determined, long-term CapEx momentum pouring into critical sectors like infrastructure and semiconductors.
The glitter and the steady hands trying to build through the grind.
And what does this all mean for the investment playbook?
Well, it seems to demand strategic diversification and definitely patience.
Absolutely. You need hedges like gold, almost as a necessity against that global instability and currency risk.
And you need a serious exploration of those deep value opportunities abroad. Leveraging the huge valuation gaps that sophisticated players, like the one we discussed, are actively trying to exploit right now.
It seems clear the easy money days of just riding domestic momentum might be getting tougher. So here's the final thought, maybe something provocative to leave you with. The sources kept highlighting this historical lesson. Protectionism, like Smoot-Hawley, it rarely brings prosperity in the long run. It usually leads to that economic grind. So given that we see central banks systematically buying gold to hedge against risks in fiat currencies, given that major global investment managers are actively hunting for deep value outside of highly priced domestic markets, does the collective action, the actual behavior of these huge global policymakers and institutional investors, does it signal a stronger, deeper lack of faith in the stability of global trade and currency than maybe any single economic statistic could ever show?
That's a powerful question. Are their actions speaking louder than the official forecasts?
Exactly. Something fundamental for you to consider as you try to navigate the glitter and the grind.